Hello, everyone, and thanks for joining today as we continue our conversation on COVID relief. Specifically today, we're going to be talking about the CARES Act update around the employee retention tax credit and how that's been extended and some rule changes that are really favorable for most small business owners. So I want to thank Lisa Carmen for joining us today. Lisa is the Vice President of Compliance at Assure and a payroll and tax expert and very, very close to all the legislation. Lisa, what do you think? We've seen more HR tax compliance legislation in the last 12 months than maybe the last decade.
I completely agree with that. Well, enough to keep our heads spinning.
For sure, especially as your team just finished up year end and getting all the year end reports done on behalf of clients. You guys are coming off of a busy month, so I appreciate you joining me today to help unpack this important topic.
Absolutely, happy to help.
Okay, so let's start out and maybe level set for folks. You got a resource here on the IRS website. If you guys just simply Google Employee Retention Tax Credit or ERTC update, it'll probably take you to this page. We're recording this so that it'll be available on demand for afterwards if you don't happen to write it down this second. But the punchline is this. With the CARES Act last spring, when the pandemic first hit, there were employee retention tax credits available and had a set of rules around that. And with the most recent legislation that passed, some of those rules I'd say have loosened up and improved, made the situation better for most employers around eligibility and amounts and timeframes and such. So I want to just provide this as a resource to you. But maybe Lisa, before I think there were 6 specific things that we really wanted to unpack for folks to make sure they understood. Can you just kind of paint a high level picture for those who don't know or didn't know or knew but forgot? What is the employee retention tax credit that was part of the CARES Act that passed last year?
So after we go through all these details, you can really simplify it down to it's a refundable tax credit against the employer share of Social Security tax. And it was, we'll go into the details, but last year it was at 50% of qualified wages. We're going to talk about the increase here and the extension and jumping that up. But basically, it allowed the employer to reduce their employment tax deposits that they otherwise would have been required to make, and just kind of free up some capital so that they can, focus on running their business rather than paying taxes.
So, obviously so much focus last year and even now in the second draw is around PPP. That's where, in many cases for most people, the big money was and where to be focused as part of the CARES Act. But just to be clear, so we're not talking about an offset of wages. We're not talking about FFCRA, if an employee is out on leave kind of reimbursement. This is just the Social Security employer's portion of Social Security, correct?
Correct. And we'll get into the details. It's just against a portion of qualified wages.
Okay, very good. Okay, so let's jump into it. So I think we've identified there's a bunch of updates. I think there's 6 of them that are really important that everybody probably needs to understand here. So first is that the employee retention tax credit, we'll just call it ERTC through today's discussion. The amount is increased. So what was it and what's the new amount and what do employers need to know?
So last year during the period of March 12th through the end of December, the annual cap per employee was $5,000. And to get to that dollar, it was $10,000 per employee in qualified wages, and you could take 50% of that. So your very top would have been $5,000 per employee. Moving into this extension, which starts January 1 and takes us through June 30th of this year, that annual cap per employee for quarters 1 and 2 is $7,000 per employee, and that's per each quarter. So that takes us up to $14,000 for the year, and it's based on $10,000 of employee qualified wages at 70%. So $7,000 per quarter for a total of $14,000 per employee for an annual cap.
So Lisa, are we only talking about 2021 Q1 and Q2, these rules, or is there a retroactivity to 2020?
So we're talking about this coming year, and an employer that received that $5,000 credit on those employees for last year can still take part in this year. So those funds aren't included here. You can still qualify if you took those credits last year on those same employees. But the dollars we're talking about now, that $14,000, is just January 1 through June 30th of 2021.
And so this would not be considered double dipping if they applied for the credits in 2020 and now do it again in 2021, or is it just the difference that they're going to be eligible for?
It would not, they're not double dipping. So if they partook in this and had a $5,000 credit on, say, you, Mike, they could, again, for your wages, January 1 through June 30th, up to $14,000 could take that credit again for this year.
Okay.
It does differentiate 2020 from 2021.
So this is awesome news, because this is not just an amount increase. It's a new period that's a larger amount on a new period. So potentially quite a bit more relief for employers. Anything else you say on the increased amount?
No, but you're leading us right into the eligibility being expanded, in that it opens the door for so much more.
Yeah. So yeah, just keep going on that. Tell us what has changed, and maybe level set. What were at least the big buckets of the old eligibility requirements, and now how has that expanded?
Mm-hmm. So for the period of March through December of last year, which was the initial period, we'll call it, if your business operations were fully or partially suspended due to, the various government orders limiting, commerce, travel, group meetings due to COVID, or you had a decline in your gross receipts of less than 50%, for that same, you'd compare it 2020 to the same period in 2019, you would have been eligible for this. So a decline of 50% for the same quarter. This year with this extension, same rules apply if you were fully or partially suspended in your operations due to the government restrictions or your gross receipts declining. This year it would be if those gross receipts for that calendar quarter are less than 80%. So really opened you wide up. You had to suffer, 50% losses. Now it's just 20%. So I think this opens it up to a lot more employers to participate in this.
Yeah, you know what we've been saying in this webinar series for the last going almost a year now, but we're all in the same storm, not the same boat. So for those who had real meaningful reduction in revenue and businesses who are really impacted, 20, 30, 40%, they weren't eligible because they didn't hit the 50% threshold. So this is really good news. Any other expansion of eligibility that we need to know about?
No, that was really it. It's pretty simple, but it fills a big gap.
Yeah, it sure does. Okay. So the next then is the wage period extending. So first, I guess, define for us, what is the wage period even mean when it comes to the employee retention tax credits?
So these were wages that were earned in the period. The initial period was March 12th of 2020, and it went through December 31st of 20. So any wages paid after the 12th and before 1/1 of 21 would be considered qualified wages. And this one is super easy. They've just extended it. So it's 1/1/21 now through June 30th of 21. So we've got a 6-month extension on this.
Yeah, so this is maybe, correct me if I'm wrong, this is maybe the best news of all, that we just extended So there's good news in increased eligibility, good news that's an increased amount, but the biggest impact financially is really just an extended period of 2 full quarters, right?
Yeah, it's a lot.
Yeah, and maybe not 2 full quarters, but nearly. So yeah, it's a lot.
Mhm.
Okay, awesome. All right, number 4, what was the disqualification and how has that been eliminated and how is that going to impact employers?
So again, Mike, I think this one really is going to open it up to quite a few more employers. So last year, you were ineligible if you were a company that had a PPP loan. You were not eligible to claim these employee retention credits. And that extended to all affiliated companies that shared ownership. So if one company of, say, your family of 5 businesses received a PPP loan and you had more than 50% ownership with the others, they were also ineligible. So that really made this impossible for a lot of employers.
Yeah, so if you were the owner in a business and you were also more than 50% owner in a restaurant and you got PPP money for your restaurant, that precluded you from getting any of this benefit for your other business. So
Yep.
I think, there's so much confusion, 10 months ago when all this was unfolding. But this one just kind of felt like a little, in a way it's free money, so maybe we shouldn't feel this way, but it felt like a little sucker punch. It's like, okay, people lining up for their PPP money, which they desperately needed, but all of a sudden, hey, here's this other thing, the tax credit. Oh no, you're not eligible. So I think this is good news. So
Yeah, and this came so fast and furious, you almost didn't have time to think about what was going to be in the best interest of your business. And it might have been such a mad dash to get that PPP loan. Would it have been more beneficial to take these tax credits? And then there was all the worry and concern and, if your PPP loan is forgiven and shoot, did I give up on tax credits for that? So the good news for this is a company with a PPP loan is not prohibited from claim these employee retention credits. So
and
there
again,
are some.
Lisa, is there any retroactivity to this then, or is this just the go forward for 21?
Yeah, they can claim it retroactively. We're waiting on additional guidance for the wages that were paid in excess of forgiven PPP proceeds. So there's more to come on that. I don't have a lot of detail on it, but there are a couple exclusions. So you can't use the credit for wages that were paid with PPP proceeds. So if you use your PPP loan to pay your employees, you would not get the credit in addition to that.
That makes sense. They don't want us to anybody to double dip, right? So
right.
Yep. So if it's retroactive, how do, and tell me, I might be remembering this wrong, Lisa, because the way you got this was on the quarterly 941s, right? An amended 941. So
right.
If you already filed your Q2, 3, 4 returns for 2020, how do you have to file? Is it just an amended return? Is there going to be a change to the 2021 941s? How is this going to play out for someone to actually execute on this?
Yeah, if you're going to go back retroactively, we'd absolutely have to do amended returns, and it's information in, information out. So it can be, to some a daunting task, but if you've got your numbers together and you've kept track of everything, it's not tough. So don't let doing an amended return sway you from doing this. So yeah, you would have to do amended returns. And some of the things to think about in thinking, hey, I could go retroactive. We just talked about the companies that were related, that one company might have had a PPP loan and didn't claim the credit due to their affiliation with their other companies. They may be able to claim that credit retroactively now. So that's one of the items we're looking for some more guidance on. And the IRS will keep it coming now that the information's flowing. We should see these things, but it does open up to those companies who were guilty by association, if you will, that, hey, you're not eligible for this. Well, now you might be.
Lisa, we should probably have you back on as we get more guidance from Treasury and IRS on this, because I'm suspecting people are going to want to understand some specifics on how to file these amended returns. It's probably going to be a short topic once we get the guidance, but we'll probably want to share that when that's available. Do you have any sense for when we expect those updates in the FAQs?
No, I wish I did. And even reading the IRS current FAQs, they actually will tell you that there are no answers in those FAQs to this extension. So they're usually pretty quick about updating them. So I think, we just keep watching daily to see what comes out. And as soon as it comes out, I'll be happy to pass it along. But it could be tomorrow. It could be a week from now.
Yeah, right. So
it's coming.
I guess I'll just invite everybody listening today that, within the next week or two, presuming meaningful material updates from the IRS, from their FAQs that they publish, that we'll share that guidance with you. Okay,
Sure.
Two more topics that we wanted to unpack here. So number 5 is whether the employees are actually working is now less relevant to their eligibility. Can you explain what the heck does that mean, less important? That doesn't, saying less important doesn't seem like a binary yes or no kind of a test.
So it seems like the whole theme here was to open this up to making more employers eligible. And they did it here too with, whether the employees are working or not is less relevant. So last year's, March to December term, it was companies with more than 100 employees couldn't take credit for the employees who were performing services. If they, so if they're still working, you couldn't take the employer credit. This year, for an employee that averaged more than 500 full-time employees in 2019, the qualified wages are those paid to the employees that are not providing services because operations, were fully or partially suspended, and we talked about that due to the decline in gross receipts and effects of COVID-19. So now for an employee that averaged fewer than 500 employees versus the 100 in qualified wages paid to employees during that period due to the suspension, they're eligible regardless of whether the employee were providing services. So before, if the employees who were not providing services weren't included here, and now it doesn't matter if they're providing services and working or not, they're including if the employer has averaged 500 or fewer full-time employees.
And just to be clear, when you say providing services, I mean that just means working, right? They're
Yep.
Yeah. So whether you're a restaurant and it's performing services for clients, or you're a manufacturer and they're building widgets, it's whether or not they are or are not working, that's now irrelevant, or is there still some relevancy? Because the idea of the whole law was to help financially incentivize employers to retain their employees, right?
Right. So, the catch, if you will, is they still had to have the decline in gross receipts, whether the employees are providing services or not. So, if you think about a restaurant is a great example, they're still providing services. They're open, their team is working, and they're doing a lot of takeout orders right now. But they're definitely not at full steam. They're not, their revenues are way down for sure.
Yep.
So they still have to be impacted in that way, but it opens it up to employers with fewer than 500 employees versus last year you had to have fewer than 100 employees.
Got it. Really. So really the big thing here is just opening up to larger employees then, larger employers. Okay.
Correct.
Okay, very good. Anything else around the relevancy of working for eligibility before we go to our last topic?
No, it's just, in keeping with the theme here, it just opened it up to more employers to, help out a greater quantity of employers.
Yeah, okay, very good. Okay, so the last thing, advanced payments on the employee retention tax credit are now available. What the heck does that mean? Because by definition, the first time around here, it was a credit for after the fact. How do you get the money up front if I'm understanding advanced payments correctly?
Well, it's a really good question, and the IRS is going to provide us some additional guidance on that. And somehow they're going to base it on, average quarterly payroll for that same quarter. But what they will do, again, this is going to be for employers with 500 or fewer full-time employees, and they may be able to request the advance payment of the credit. And to do so, we go back to the Form 7200 that was introduced, oh gosh, I don't remember if it was second or third quarter now, but introduced to us last year, where the employer could submit for that credit before filing their returns. So it'll be similar to that process. It's going to be the same form, but we're awaiting guidance. So I'm hoping that comes out, as we were waiting for guidance in other areas here, that we get a bunch of FAQs here that answer some more questions and how you could do that.
And the name of that form then is Form 7200, you said?
Yes.
Okay.
Yep.
So presumably employers will use the Form 7200, and based on an average of prior quarterly filings, not their 941 filings, and what the gross wages are, that will be then used as an estimate for the advance payments. That's kind of the best guess. Is that what you're saying?
Yep. That's what we're presuming at this point. And they could always change it up, but it seems logical to me. Like, how else would you, come up with that number? So, and if they keep it to that, I think it would be fairly simple to come up with those dollars. You're going to have your 940s, 941s that you can refer back to get those numbers pretty quickly. And the form is, very easy to use. So if they stick to that, I think it'll be a fairly simple task.
Yeah, very good.
Yeah.
Okay, well, Lisa, I very much appreciate your time. I feel like this is one of those topics that, PPP just sucked all the oxygen out of the room in 2020, because that's where the big dollars were sitting. And because there was so much confusion around PPP or the ERTC, that people probably left a lot of money on the table just because it was darn complex to try to figure out, and it didn't have as much attention. But here, hopefully making it plain and clear, as our job at Assure is to advocate on behalf of small businesses and entrepreneurs. There is money on the table that you really need to take advantage of. So hopefully this helped explain it. Lisa, so regardless, I guess, Lisa, if somebody is an Assure payroll customer, or they work with one of the other national brands, maybe they do payroll in-house, what's just your most practical guidance for them to take advantage of the tax credit?
So that's the key here, Mike. You just nailed it. It's a tax credit. So it's not like the employer FICA tax deferral that we talked about last year. This is a credit. You don't have to pay it back. So it's definitely worth looking into. If you're an Assure client, absolutely speak with your CSR about this. We're actively programming for this. I wish I could say we're 100% there. We just finished up year end, but we're ready for it, and we'll make this available. But talk to your customer service rep. If you use another payroll service, everybody's jumping on this, everybody's addressing this, so you won't get left out in the cold on it.
Yep. Okay, Lisa, look forward to talking to you again. We'll invite you back as soon as we have more clear guidance from the IRS. and we'll probably walk everybody through the FAQ and maybe some more just practical, tactical advice on how to file an amended return to take advantage of this. So thanks everybody else for joining today. Our job is to help companies grow. We provide human capital management software and services for over 60,000 small and mid-sized businesses. We do this to help them stay compliant, to save money and grow their businesses in 2020. And I'd say certainly out of the gate here in 2021, I think our job is to help a lot of businesses survive. So the best information we can provide to help you do so, awesome. And I cannot wait for later this year as we kind of start pivoting these topics out of pure compliance and survival mode into how we start talking about how to build teams that help our companies grow. So until that time, Lisa, thanks again for joining me, and look forward to talking to you and everyone else next time.
Thank you, Mike, and thanks everybody for joining.